Welcome to the Debunking Economics podcast with Professor Steve Keen. I'm Phil Dobbie, and today, growth. Are we kidding ourselves? In economics, we're obsessed with growth. We need it to survive, apparently. The faster the growth, the better off we all are. But is that really the case? And if so, why has growth slowed? And what if it slows even more? What if we never see high economic growth ever again? Like Japan, for example. We'll look at that today on the Debunking Economics podcast. Well, there's a concern now that maybe Europe isn't going to see the sort of growth that the US seems to be claiming, that perhaps the ECB will continue with its QE, its quantitative easing program, for a while longer, with annual growth of the Eurozone economy now at 2.5%. It's not got much above 3% since the financial crisis, and the UK economy, well, that's trundling along at 1.2% growth. Even in the US, GDP has slowed from an annual rate of 2.9% in the final quarter of 2017 to 2.3% in the first quarter of this year. But does it really matter? I mean, Steve, we're seeing now just about everywhere near record lows for unemployment. We're not exactly starving. In fact, we're eating too much, if the truth be known. And Japan has managed to survive with growth just above zero, sometimes below it. So, and they're still here. So do we focus too much on the importance of economic growth, do you think?
Absolutely. But the part of the reason why we do that is because economic theory has never really understood what causes growth in the first place. And therefore, any of the potential constraints to growth or the issues, the problems with growth, haven't even been part of the theory in the very first instance. It's all about just getting, as high a level of economic growth as possible, and that's been the only scorecard that counts.
Right. And why is it so slow? Why is it slowing now? What have we missed out? The people who are looking at this is the important indicator. Where have they gone wrong?
Well, there's at least two factors that are part of it, and one of them is, of course, my favourite subject, level of private debt.
Yeah.
Because one thing which comes out of my modelling, which has turned up in the data as well, is the higher the level of private debt, rate of growth of private debt, the lower the rate of economic growth. And partly the reason for this is simply that the people who are fundamentally responsible for economic growth in the sense of enabling it to be possible to make more physical widgets every year than the widgets the year before are capitalists who make investment decisions in building factories. And the higher the amount of money going to the banking sector, whatever way it gets there, ultimately there's less money available for actual building of factories by capitalists, less investment in new technology and so on, and you get a lower rate of growth. And I get it in quite a simple way. I get that in a very paradoxical way in some ways. I get that out of incredibly simple models where I have capitalists desiring to invest more. So a more aggressive capitalist class having a higher reaction to a higher rate of profit in terms of how much they're willing to invest rather than the lower one. Even though that would give you, you would think, a higher rate of economic growth, it ends up giving a higher amount to the bankers and a lower rate of economic growth. And that again seems to be what's turned up in the real data. The higher level of private debt has got, the lower the rate of economic growth has got over time. That's factor one, but it's not the only factor.
Right. So just on factor one then. So, is that the situation with Japan then? Why is Japan sitting with such slow growth and has done for so long? That's not because of private debt, is it?
Yes, it is. They were the first one. They were the first canary in the coal mine. Japan, I hope you're old enough to know what they used to call the bubble economy in Japan. Do you remember that?
Yeah.
Okay, 1980 to 1990, and what happened all the way from the end of the Second World War through to 1970. One of the distinctive features of Japanese capitalism was what they call the keiretsu system, where you didn't just have separate corporations in ultimately car manufacturing. Of course, they didn't have it to begin with, but steel manufacturing, food, textiles, etc., etc. You had groups which had, to some extent, a history in the feudal structure of Japan, which were called keiretsus, which were agglomerations of different industries. And they had as part of each keiretsu, there was a bank. The Mitsubishi Bank was one bank. There's numerous others, and that bank would actually effectively act like an equity investor in the firms in that group. So that would provide loans, not because your application was better than somebody else's application, but because you're part of the same industrial group, and the Mitsubishi Bank lent to the Mitsubishi keiretsus. So consequently, the level of private debt in Japan was much higher than the level of private debt in Europe or America, let's say. But that reflected the fact that these keiretsu was sort of a semi-equity concept rather than just private banks providing money to independent private non-financial corporations. Then in the 1980s, the whole of Japan went crazy with share market speculation and property speculation. On the one hand, you had the Nikkei getting to the stage where 7 of the world's 10 biggest banks were all Japanese, and wasn't that a fantastic indicator? And at the same time, the area of the Imperial Palace in Tokyo, which, to give you an idea of its size, I think I used to lap it in about 15 minutes. That was worth more than California.
Right.
In terms of the valuation of real estate. And that was all driven by both the household sector and the corporate sector getting involved in both share market speculation with margin loans and property speculation with mortgages. Japanese went out to having 99-year mortgages, so you'd sign up in a mortgage which would indebt your great-grandchild to finish off paying the mortgage. And then it's all been downhill from there. So they peaked at they had peak rate of growth of debt in 1990, literally came to an end right on the very last day of 1990. Then you had debt itself peaking in about 1993-94, and over the last 20 years they've gone from a debt level of 225% of GDP, this is private debt, to about 170%, so they're now back in the range that America's been. But that whole period, the credit growth, which was a fundamental part of Japan financing investment in new technology through the Keiretsu system, came to an end. So the country's been stagnant for 25 years.
So that's
exactly the same situation America and UK now got themselves in.
Right, and that sort of gets me back to that first question about how important is growth. Because, I mean, if we look at Japan's GDP, it shrank 0.6% in the first quarter of this year, which sounds like it should be catastrophic. And yet we don't hear about, stories of hardship coming from Japan. They are clearly muddling through, despite the fact they've got no growth, in fact, negative growth.
Yeah, they've also had a declining population level. So it's really, in terms of what happens to the employment of the country, the per capita rate of growth is more important than the absolute rate of growth. And because Japan's in the not quite unique situation, but still rare situation of the declining population, that 0.6 decline in total growth is less than a 0.6 decline in per capita. But it'll still have an impact. I mean, I'm not saying Japan is a growth a beacon at the moment either, but it's gone through its debt crisis. It is still in the same situation America is in overall. So the growth is incredibly fragile from the financial side. And that's one factor. The other one that matters, and this is not so much brand new, but it's starting to bite, and that is the capacity to actually produce more goods one year than the next, which is what economic growth comes down to, based on the capacity to exploit energy and what's called the energy return and energy investment. And that EROI has been declining as the last century and a half has gone on, because we've exploited all the extremely high energy return and energy invested oil, things like the original oil fields and so on, and we're now starting to go back into the reason we had.
So it's like diminishing returns on our energy extraction, in effect.
Diminishing returns is one way to describe it. Economists have bastardized and ruined that particular concept, but what it amounts to is that when we first tried to get oil out of the ground, it was literally aim a shotgun trying to shoot a rabbit, and you establish an oil empire in the Beverly Hillbillies manner. Now you go for something like what was the one that blew up in the Gulf of Mexico?
Well, the Deepwater Horizon, I think it was the BP oil platform that blew up.
Yeah. You're down 1 or 2 kilometers below sea level, and you're drilling another 2 or 1 or 3 kilometers through the bedrock of the ocean to try to reach a pocket of oil, which of course explodes up the column. But the amount of energy you've got to do that is dramatically higher. So if you go back to the early days of the Pennsylvania oil, when oil was first discovered in Pennsylvania, I think that was the first time it was found and exploited as a commercial venture, that had an energy return and energy investing of something at the order between 100 and 300 to 1.
Yeah, because it just shoots out the ground. I mean, now we're resorting to shale oil, which is a very energy intensive and labor intensive project in itself. So that's the other factor.
That's the factor number 2. Yeah,
and we talk more about that constraint on growth, the whole energy thing, which really started with the Club of Rome back in the 1970s. You can listen to the full version of this podcast, which runs for about 35 minutes. If you're a subscriber to the Debunking Economics podcast, you can do that by going to debunkingeconomics.com and choosing one of the subscription plans in the right-hand side of the website. Or you can become a supporter of Steve Keen on Patreon. If you go to Prof Steve Keen at Patreon, patreon.com/Prof Steve Keen. If you provide $10 or more support per month, you get access to the full version of this podcast and all the others. There's over 100 of them now. So do support Steve's work and get access to the podcast, and we'll see you back here very soon. Thanks for listening.